So good afternoon. Welcome everyone to our first Truepoint Talks of 2024. My name is Abby Tukey. I am the Director of Marketing and a shareholder here at Truepoint Wealth Counsel. We are excited to have you all with us today. I know we have the Truepoint Wealth Counsel clients with us, as well as our Commas clients too, and plenty of guests. So to that end, just a quick introduction. So Truepoint Wealth Counsel and Commas. We are one company and one team with just two distinct service offerings to really meet people where they are in their financial journey. And at the core of both client experiences is thoughtful financial planning, tax-aware portfolio management, and the guidance of a certified financial professional. And because we have these two service lines, we're able to work with anyone regardless of where they are on their financial journey. So speaking of financial planning and portfolio management, it's my pleasure to introduce our two panelists for today. First, we have August Hemrick, who is a financial planner on the Truepoint Wealth Counsel side. August holds the CFP, Certified Financial Professional designation. She'll be offering some tips and strategies as we look at 2024, some of which will appeal to those who are still in their working years. Other tips might be more appropriate for the people who are nearing or are in retirement. We tried to do a little bit of mix to appeal to a broad audience today. And after August wraps up, we will switch over to Connor Feldman. Connor is a senior portfolio manager working on portfolio management across both Truepoint Wealth Counsel and Commas. He is also a shareholder at Truepoint Wealth Counsel as well. He will be giving a look back on what happened in 2023, as well as offering some commentary on what's to come in 2024. So with that said, I'm going to turn it over to August to get us started.
Thank you, Abby. So as Abby said, my name is August Hemrick. I'm a certified financial planner here at Truepoint Wealth Counsel. And today I have 6 financial planning tips for you going into 2024. So as Abby said, this is applicable to you if you're working, if you're retired, and you may know people in your life that you can give these tips to and help them out as well. So the first tip I have for you is about savings rates and tax withholdings. You may have received your first paycheck for the year. You may be waiting on it, but I highly encourage you to take a moment when you receive that and look at your first pay stub of the year. Check your tax withholdings, make sure everything looks great. Log in to your employer-sponsored retirement accounts, check your savings rates. Whatever you were saving last year, hopefully you can save a little bit more this year. Even if you were maxing out your 401k or your 401(b), those contribution limits have increased this year. So it's a great time to go log in, look, and make sure that the saving rate that you're at is still maxing that out for this year. So speaking of those contribution limits, the first account I wanted to chat about is the IRA, or the individual retirement account. This is a good time to consult your advisor about whether it makes sense for you to contribute to a Roth IRA or a traditional IRA. Regardless, the contribution limits are the same, but really it depends on your income level and your age, what might be the right choice for you and your spouse if you have one. So in 2023, you could contribute $6,500 to an IRA. And if you were over 50, you could contribute an additional $1,000. In 2024, you can now contribute $7,000. So if you have this in an automated fashion, log in to your IRA and make sure that you update that for 2024 so that you can fully take advantage of the opportunity to have up to $7,000. And if you're over 50, the catch-up contribution for 2024 remains the same at $1,000. Similarly, those employer-sponsored retirement plans like 401ks, 403bs, 457bs, their contribution limits have increased as well. So last year you could contribute $22,500. This year you can contribute $23,000, and if you're over 50, you can contribute an additional $7,500. So this is where you want to log in, check your savings rate, and make sure that you're continuing to maximize this account if you've been maximizing it in the past. I'd also highly encourage you, if you're a young working professional and maximizing your account is just not where you're at right now. Let's say that last year you contributed up to your employer match. That's a fantastic place to start. I would encourage you, let's say your employer match is 5%. I would encourage you to go in and make it 6% for this year and just create that healthy habit of increasing your savings each year and getting just a little bit more aggressive over time. That's going to make a big difference in your overall retirement savings in the future. It doesn't feel like it at the time. It may feel small, which is great because it has smaller impact on your income for the year, but it can make a big difference on what you have at the end of the day for retirement. Next is a special account, these health savings accounts. If you have a high deductible health plan, you're eligible to contribute to a health savings account. These are special because the amount that you contribute to a health savings account reduces your taxable income. It's pre-tax dollars. They never expire. They roll over from year to year. They're not a use it or lose it type of thing. So theoretically, you could maximize your health savings account every year, invest the money, and have it be a tax-free retirement account to be used for qualified medical expenses. As the money leaves the account, it's never taxed as long as it's used for a qualified medical expense. It's also something where you can hang on to your receipts and be reimbursed sometime in the future. So there's a lot of flexibility with this account. In 2024, for individuals, so if you're on an individual high deductible health plan, you can contribute $4,150. And if you're on a family high deductible health plan, you can contribute $8,300. If you are working with Truepoint or a Commerce advisor, make sure that you're mentioning to them that you're on a high deductible health plan and that you do have access to a health savings account, because there are strategies that they can talk you through and make sure that you're maximizing this account. For example, let's say that you and your spouse are 55. Your spouse has a high deductible health plan through his employer, and you are a dependent on that plan. He can contribute $8,300, which is the family maximum, and an additional $1,000, so he can contribute $9,300 for 2024. But you are also eligible to open up your own HSA and contribute $1,000 yourself. So that's an additional $1,000 of pre-tax income that you could have for the year that can go into that HSA. Another thing that a lot of people don't know about is, let's say you're on a family plan and you have an adult child that's on your plan. They're eligible to contribute to their own HSA. So you can maximize your family contribution limit and your child can contribute to their HSA. So whether your child has additional income or you have additional income to help them bolster that health savings account, that's a great way to get them started in their adult life. So moving on, the next tip I have for you is about college funding. And this is one that really can apply whether you have little kids, you have kids in college, or you're a grandparent thinking about helping your children and your grandchildren get through college. So the first thing to consider here is the FAFSA. This is the free application for federal student aid. College students know all about this. It's typically filled out in October, but this year has been a total mess for the FAFSA. It was redesigned, it was delayed till late December. It's now open, but it's intermittently closed because it's having a lot of glitches and there's been limited availability, unfortunately. Hopefully, at the end of the day, the changes made to this make this process a lot more efficient for students. The idea was that it would have fewer questions, that it would be more automated, so there would be less manual entry of colleges. And they actually are changing the way that they calculate the amount a student will receive in aid. So as I was reading about this and learning more about this, I think that there are some areas where it's really going to help parents, and then other areas that I could see where people would be frustrated. The first one being that in the past, you've always received like a sibling discount for having multiple kids in college. Anecdotally, people chat about this all the time. That's a benefit of having multiple kids in college. That is no longer going to be a factor in the amount a student receives in aid. But if you are someone who's maximizing your 401k, let's say you're putting $23,000 this year in your 401k, that income is removed from the calculation. So it's directly reducing your income. And so it's protecting some of that retirement income, keeping it out of this calculation. And then lastly, with the FAFSA, students should just expect a delay in receiving their financial award information because it's been such a mess this year. So while this has been a mess, there's actually something really exciting going on this year that we've been waiting for, and that is these 529 to Roth IRA conversions. We see this often where let's say a grandfather, he and his wife create a 529 for their granddaughter. granddaughter grows up. They start it when she's little. She grows up. She goes to college. She ends up going to college for less money than what was saved in the 529. So let's say there's 100,000 left over in this 529 at the end of the day. She's not interested in grad school. She's done. She's launched her career, and it's great for everybody. But now there's this money left over. So historically, our options have been one. Let's say she has a brother. We could change the beneficiary to her brother. Grandfather could change the beneficiary to himself or to any other family member. If they wanted to give the money to granddaughter, they could take the money out, but they're going to pay taxes and penalties. So really, there wasn't anything that was really exciting there where they could easily give the money to their granddaughter that was not used for education. Now, starting in 2024, up to 35,000 of these excess funds per individual can be converted to a Roth IRA. And here are some of the stipulations. So one is that the beneficiary of the 529, so in this example, the granddaughter, and the owner of the owner of the Roth IRA would need to be the granddaughter as well. So it needs to be the same person. The 529 also needs to be at least 15 years old. For most people, they're starting a 529 when their kid is little. But if you started it as they're older, you just need to be mindful of waiting till they're maybe in their late 20s to start doing these. But it's still an option. And that money can still sit and grow while you wait to do this. And then there's more stipulations to this, but these are the main ones that you really want to be mindful of. And it's a great time to consult with your advisor on this too, because this is such a new thing. And we're trying to stay right on the edge of making sure that we're doing this correctly starting in 2024. But basically, you want to let granddaughter know that you're completing this conversion. Because let's say she's working and she has another Roth IRA that she's opened, not knowing that grandpa is doing this, and she is putting in money that she's earned into that Roth IRA, she can't double dip. If there's been a 529 to Roth IRA conversion done this year and she's met that $7,000 maximum for 2024, she can't put more money in there. So basically, this is going to take several years because you can do up to 35,000, but you can't do it all at once. You're subject to that Roth IRA maximum. So let's say in this example that grandfather, he's finished the 35,000 for his granddaughter. It's been several years and they've completed the $35,000 maximum that she can have. Let's say there's still 60,000 left behind. What we are gaining clarity on this year is, can he change the beneficiary to himself? Can he change the beneficiary to another family member and start the process over again of doing Roth IRA conversions to that new family member until the money is exhausted? We have to clarify when that 15-year timer starts. If it starts at the opening of the 529, it doesn't matter when a beneficiary is changed, or if it restarts when there's a beneficiary change. So more to come on that. But that is a really exciting new thing, new option for 529s. Next tip is similar to that of a health savings account, but it's for those that do not have high deductible health plans. Employers offer these health flexible spending accounts, and independent of what kind of health plan you are on, your employer may offer a dependent care spending account for your childcare expenses. So the reason I'm mentioning these is that many of you may have unused FSA funds that have rolled over into 2024, and they need to be spent within a grace period. At the maximum is March 15th, but many employers may have a sooner date. So you really want to check your balance on your FSA, submit any receipts for unreimbursed expenses. And also just something good to add is that these rollovers don't reduce your contribution limit for 2024, but it is a good time of value to evaluate what kind of expenses do we foresee our family to see in this year, and how much should we put in. Examples of these eligible expenses, if you don't have receipts that add up to $610, you can get supplies for your medicine cabinet, allergy products, sunscreen, vaporizers, eye exams, dental visits. For the dependent care FSA, that's work-related childcare, preschool tuition, summer camps, adult daycare, things like that. All right, now for those attendees that are retired or approaching retirement, the Social Security cost of living adjustment for 2024 is 3.2%. So it's a great time to check your first Social Security payment of the year, or your Social Security statement that you may get in the mail, or log onto the Social Security Administration to your account there and check on everything, make sure everything looks good, check what your Medicare premiums are for the year, and just make sure everything is correct. So as I said, that cost of living adjustment for this year is 3.2%. I've also included the earning limits. They've been adjusted a bit for those that are on Social Security that have not yet reached full retirement age, which depends on the year that you were born. I'd also like to add that if you're working with Truepoint or Commas, or thinking about working with us, Social Security is an area where an advisor can add a lot of value. We take a very holistic approach to Social Security. So if you're married, we're taking into account your primary insurance amount, your spouse's primary insurance amount, your ages, what you're earning at the time, any pensions or any other lifetime income sources that you have, what your portfolio can sustain, while also taking into account the benefit you receive, about 8% each year that you defer your Social Security up to age 70. So we're able to really create an optimized Social Security strategy for you that can make you feel really good about when you turn on those benefits for you and for your spouse. So for many Truepoint clients, they never even look at these numbers because we've gone ahead of them and made a strategy that this doesn't even affect them. Next is something that I think everybody is talking about. This fifth tip is about the interest rate environment. So we're still in a higher interest rate environment than what we've seen in the recent past, which has its pros and its cons. One being that if you have excess cash, this is a great environment for excess cash. So hopefully everybody attending has an emergency fund. And maybe aside from an emergency fund, you have other cash on the side that's for a short-term savings goal that's going to be needed in the next 3 years or so. If you have more cash than what you might need for maybe a home renovation or something that's coming up soon, talk to your advisor about getting that invested. But this is cash that is going to be needed in the near future or should be on the side like an emergency fund. If you have your cash at a big name bank, you probably are not receiving the market savings rate. You really want to consider moving that cash to a high yield savings account. So many of our employees and our clients, they like Ally Savings Bank. They also like the money market accounts at Fidelity. You can also go to bankrate.com and see the current interest rates and pick an account from there as well. That's very helpful. And then next, thinking about the borrowing side of being in a high interest rate environment. Right now, many interest rates that people are coming back with for cars and for homes, they're similar to what you may get from the market in long-term from your portfolio. So because of that, you really want to weigh the benefits and risks of borrowing. That's a great time to pull your advisor in and just really decide what is the best way to source the cash needed for this transaction that I'm going to do, whether that's a home or a car, really figuring that out. And the last tip I have for you, the sixth one, is an insurance review. So at Truepoint and Commas, we are not insurance agents. We don't sell anything. We're fee only fiduciaries, meaning the only money that we receive is the fee that our clients pay us. We don't sell any products, whether investment or insurance. However, we are very concerned with the risk that our clients hold. So we are evaluating their need for life insurance. So let's imagine that you're working and you have children and you have a spouse. We're going to take the time to really see, okay, what is an adequate level of life insurance for your family? What is an adequate level of disability insurance that's going to protect you and your family's spending ability? As you get older, starting in your late 50s, we're going to start evaluating your need for long-term care insurance and your ability to pay for long-term care expenses. So in some cases, we may recommend that you reach out to an independent insurance agent and quote long-term care insurance. And in other cases, we may say, this is better for you to self-insure. So we're analyzing those opportunities for you and coming up with the best result. And then last, for property and casualty, we refer you to an independent insurance broker that can go through your coverage, really with a fine-tooth comb, look for holes, look for areas where you're underinsured, areas where you may be overpaying, areas where you could change a deductible to make something different. Really, it's good every couple of years to take a good look at your insurance coverage and make sure you're getting a good value for the premiums that you're paying, and then it still meets you and your family's needs. All right, so I feel like that was really quick. That was 6 quick tips for 2024. If this feels overwhelming to you, feel free to reach out to Truepoint or Commas. We would love to hold your hand through 2024 and really all the years to follow. Thank you.
All right, well, we're going to do a little pivot here, and we're going to bring Connor Feldman into the presentation. And for those who don't know, I meant to mention this at the top of the program. Connor has a very informative and enlightening blog that he runs called Demystifying Markets. And for those of you who are familiar with it, I think as we go through some of this content, you'll see definitely Connor's tone and the way he tells stories is again, very similar to how he handles the blog. So in the follow-up email that we'll send to attendees, we'll link out to Connor's blog as well, and you can stay tuned to that. But for now, I'm going to turn it over to Connor.
Great. Thanks for the plug, Abby. Let's go ahead and get started. Really strong year in markets. Global stocks up 23%, which is more than double the historical average. Global bonds up about 6%, which is right about in line with average. And in talking to clients the last few weeks, many are surprised to see returns this good. You get the vibe that it didn't feel like such a great year. And let me explain why. We started the year and the US hit the debt ceiling, which prompted the Treasury to take extraordinary measures. And then in February, the Fed raised interest rates. They were continuing this path of interest rate increases that they had started in 2022. And then we had the first of a slew of bank failures. When Silicon Valley Bank failed in March, that was the largest bank failure since 2008. And then Signature Bank failed. Credit Suisse, which had been around over 100 years, failed. Clearly, something was broken, but the Fed maintained that they were going to continue hiking interest rates. And then First Republic Bank failed, which took the crown of largest bank failure since 2008. And then here we are in May, and the Fed raised interest rates again. And then the White House warned what might happen if we defaulted on our debt. It could wipe out 8 million jobs, plunge the stock market. In July, Fed raised again to the highest rates in 22 years. In August, Fitch downgraded US credit for the first time ever. In September, oil prices surged and hit a new high. In October, we had terrorist attack on Israel. And then late October, all 3 major indexes on track to fall for 3 straight months. So S&P entered a correction. This is what you experienced last year. Those returns on the last slide were great, but this is a more accurate depiction of how the year felt. And so a major takeaway from 2023 is that you can never let anybody tell you the easy money has been made. It's not true. It's never been true because there's always risks in investing. And those ever-present risks sometimes cause our investments to fall, but it's impossible to predict when that might happen. And so combine that with the media's unrelenting drumbeat, constantly reminding us of risks. And no matter how good returns are over a short period of time, they're never easy. Okay, this next slide, this is a joke going around the internet. It's describing the typical game day for an NFL fan. And it also describes our experience in investing. And so this is stage 1. Oh boy, I'm excited to watch my team play. And similarly, at the start of each year, we're hopeful for the great investment performance we'll see that year. And then in stage 2, the Bengals give us 3 hours of stress. And in financial markets, we get a year of nonstop volatility. And then we have stage 3, end of the game. Oh, nice, we won. Can't wait for next week. And at the end of a year like 2023, we're happy about our investment performance momentarily. And then we wipe the slate clean and start all over again, getting excited about the next year, completely forgetting the struggles that we experienced in stage 2. And this gets exponentially worse as more time goes by. 5 years from now, we might not remember any of the specific risks that we faced in 2020. We'll look back at 2023's return and say, man, I wish I could get that again. And that's not wrong. It was a great year for portfolios, but that mentality totally glosses over the daily stress and volatility that we experienced in stage two. And enduring stage two was a requirement to earning the returns from stage three. And so maybe you remember this commercial from a few years ago, McConaughey driving around, Lincoln, and he says, sometimes you've got to go back to actually move forward. We're going to do that. Before we get into 2024, I want to go back to consensus predictions from 2023, because there are two lessons to be learned. And I'll emphasize each of these at the end, but see if you can pick up on them while I present this next section. So the first prediction comes from Bloomberg Economics, who foresaw a 100% chance of recession in 2023. And of course, 2023 came and went, no recession. And instead, the economy has been astoundingly resilient. You might think that economists know enough about probabilities to say 99% chance of recession and can give themselves a little bit of wiggle room, but here we are. And then later in the year, now we're in October, economists opined on the future of interest rates. At this point, it had been about 17 months since the Fed started their rate hiking campaign. And the world was just coming around to the idea of higher for longer interest rates. So it's not surprising that the top economists here were unanimously predicting that it would continue. We'd have higher interest rates. And they got the timing of this one almost perfectly wrong. This was published at the Red Arrow. The very next day, interest rates peaked and have fallen sharply since. Okay, so 0 for 2 on economic predictions. How about stock market predictions? Heading into 2023, Wall Street strategists called for a decline in the S&P 500 for the first time since 1999. They predicted a fall. What happened? S&P gained 26%. I could go on and on with failed predictions, but the first lesson is probably clear. Prediction is pointless. You've heard us say it before, you'll hear us say it again. Can't be done. And maybe a more interesting question is, why not? Why can't we predict major events in the future? And that's because truly havoc-wreaking events are almost by definition unpredictable. Let me give you a few examples. The Economist is a publication that I respect. And every January, they publish a really well-researched issue previewing the year ahead. They look at the biggest stories around the world and try to identify what events will shape the upcoming year. The January 2020 edition did not contain a single word about COVID-19. The 2022 edition did not contain a single word about Russia invading Ukraine. Going back further, think about the most impactful events of the last century. 9/11, Pearl Harbor, the Great Depression. The reality is this: the most consequential events are the ones that blindside us. And they are so consequential because they blindside us. And so I don't know what the next calamity will be, but I'm confident it won't be something that is being currently written and talked about. Okay, so the first lesson of prediction is that prediction is pointless, which brings us to the second lesson of prediction, which is actually rooted in psychology. Humans crave prediction. Let me give you some examples. What's the highest rated segment of every pregame show? It's the last one, where panelists give their predictions. In September, I was at an outdoor wedding. I probably checked the weather app more that week than I did the rest of the year combined. Hearing our thoughts on what the market might do in 2024 might even be a reason we registered for the webinar today. And that makes sense, because the tendency to gravitate towards prediction is amplified when the stakes are high. And where could the stakes be higher than in your portfolio, where your hard-earned dollars are at stake? And so we have this dilemma. These two lessons are conflicting. The logical part of our brain knows that prediction is pointless, and yet we have this natural craving for them anyway. And we have to figure out how to balance those. And it does have to be a balance, because if you give in to your proclivity towards prediction, you will be led astray when predictions go awry. But on the other hand, if you try to ignore all predictions entirely, you might feel worse off. Burying your head in the sand and ignoring all predictions, especially when the stakes are this high, can feel irresponsible or downright dangerous. So how do we resolve this dilemma? We invest in preparedness, not in prediction. And we do that in two ways. We set broad, realistic expectations about the future that are rooted in historical precedent. And we construct portfolios that are built to last. We invest so that when the unpredictable becomes reality, our financial plan can do it. With that, let's dive into some expectations about 2020. And to start off, I think we can expect continued violence in the Middle East and Ukraine. These type of geopolitical events aren't typically solved quickly or peacefully. I think we can expect the Fed to continue to struggle to balance between fighting inflation versus keeping monetary policy too restrictive. This is already well underway. You can expect an ugly election cycle. We should expect stock prices erratically darting around every day. And then experts crafting compelling narratives about the market's seemingly random movements and predicting what might happen next. At some point in the year, again, this is based on historical precedent, we should expect stocks to decline 10 to 15%. And that's why if you're drawing from the portfolio, we allocate to bonds as a buffer. We think that different areas of your portfolio will perform differently. And we'll use that dispersion to rebalance, systematically selling high and buying. And this last one gets its own slide. Whatever chaos ensues in 2024, there's a 75% likelihood that the market ends higher at the end of the year than where we were at the beginning. And those odds climb to nearly 90% 5 years from now. So whatever risks we'll face this year, we remain steadfast in our belief that we should invest for the long term. So with these broad expectations and portfolios that are built to last, we're excited about what 2024 might bring.
Thank you again for joining us today. And if there's anyone that we can help, please send them our way. We'd love to have that conversation. And the more people we can help, it's really meaningful to all of us. So thank you again, and we'll see you on the next one.